Welcome to Gold Silver Pros.
What do you think it's meant for the BRICS nations to form their own currency, as Russia said that they were doing their own challenger to the dollar in all of the trade agreements that they've made? What does that say for the long-term viability of the dollar in your eyes?
Well, I don't think it means the end of the dollar. It just means that there will be less demand for dollars. And I get a lot of comments. Well, these BRIC countries, they're dictatorships, they're like third world countries. That may be so, but if they don't use the dollar to buy their imports, they're going to be using something else. And even if they are dictatorships or not as developed or advanced, they're still not going to, they're going to decrease the amount of dollars they use. And I think in the past, countries have tried to do that, like Iraq and Libya, and we know what happened to them. But now the BRICS are becoming, they are powerful nations, and it's very hard, I think, for the West to just punish the BRICS. And we've seen recently that even Saudi Arabia, according to the South African president, said that they're thinking of joining. So yeah, the dollar will still be around, just like the pound still around after being the reserve currency in the 19th century in the run up to World War I, but it's a lot weaker and not as significant. And I think the same will be for the dollar. But what it will mean for Americans is that everything's going to be more expensive, the things that they need to survive on. And it could be a good thing in the long term, a blessing in disguise. It means that Americans will have to start producing things and exporting them to earn their way in the world, because with the reserve currency, they've had that term, the exorbitant privilege, just to print the money and buy whatever they want, while other people have had to earn their way.
Do you think we're witnessing the death of the middle class?
Oh, I think we have been. Yeah.
I know it's been shrinking.
That started really back in the 90s. You know, there is no level playing field. Amazon came out and Wall Street made sure that they had plenty of money, so they did not need to have any profits. Well,
yes.
I know people that used to own stores, right? Mom and pop shops. That was the norm when I was growing up. And, you know, they have to make a profit or they can't stay in business, right? They had to charge taxes. Did Amazon have to charge taxes? Nope. So they let that play until they essentially forced any of those mom and pops either out of business or to work for them. And now they're charging taxes.
Well, Robert, I'll tell you the truth. I did watch some of those videos, and I am aware of it. I have a general ballpark idea of what you guys were talking about.
Yeah.
And we're talking exclusively about silver here, but the shortage in gold, I would suggest, by what we're seeing out there, is that we're starting to see signs of that as well. So let's not forget gold. But the big story about Perth Mint and 𝘎𝑃𝑔, since you brought them both up, is something that Ted Butler's been on for more than 20 years ago. He wrote articles about this, and about 17 years ago, he wrote another one recently last year about these sales of phantom silver. You can buy these. What are they? I can't remember what they call them, but you can buy these. You buy the silver, but you don't actually own the stuff. Okay. And nobody knows for sure how much of this phantom silver that 𝘎𝑃𝑔 or Perth Mint have sold. And but there's lots of it out there where you can buy it at spot. It's unallocated. And Ted figures that's the biggest scam out there with the Perth Mint. And of course, you mentioned this other thing with your friend that did the auditing. I'm not discounting that. I just don't know enough about it to make a comment on it.
Yeah.
But there's lots of other smoke flying around the Perth Mint right now, and I'm pretty sure that if once they do some digging, they're going to find a lot of stuff in there they're not going to really like.
Would you Would it be, and just asking your opinion on this, would it be safe to say that if we were looking at the gold and silver market from start to finish, when we pull it out of the ground to the point at which it goes to a retail or industrial sale to someone, would it surprise you if at every step along that way there had been a bunch of double counting or rehypothecation or covering up of actual physical supplies? I mean, if it came out there's a big scandal on gold and silver across every step of the supply chain, would that surprise you at all?
Well, I'll tell you what, you're talking of a whole thing that, I know I know something about.
Yeah.
The mines produce either the ore or the doré bar, which goes to the refiner, and they refine it into the metal. Now, I doubt very much, but I don't know for sure, so don't quote me. So nobody take me as this is gospel. I doubt very much there's much hanky-panky going on up until the time it's actually refined into the physical product itself. Once it gets to that point, then, well, all bets are off. But, the physical market is totally different than the paper market, and I think that's a differentiation that has to be made. The fact of the matter is that, as we started at the top of this show, the physical silver market is in a huge deficit. The demand is way, way more than supply. And when we start to see problems in the silver market, it's going to show up in the paper market where, the thing is going to finally blow sky high. So one of these days, the physical market will trump paper. And as you and I and everybody else in the world, that's the day that we're waiting for.
When people need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
I wondered whether there are some market tests of whether you're being heard. And I think about TLAC. So TLAC should respond to good and bad news about the institutions. And it's really important. I mean, it's a little bit conflicted, right? I mean, it's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they're going to be. And it could be an early warning signal to the FDIC and the primary regulators when these things happen. And there may be some other prices. This is similar to what Jay was saying in the market that you can tell whether people understand who's going to be protected, who isn't going to be protected. It would be, I think, an interesting study to look at the evolution of market prices in a situation like March of 2020, for example, and see whether people understood what might happen.
I'd like to go back to some of Dick's early comments. I do think it is hard to get a lot of demand for transparency right now in this sort of period of peacetime. But that is going to flip, and it's going to flip probably even faster than we saw in 2008, where the need for communications really quickly in the social media world to avoid disinformation, to have some holding patterns for things like, I remember in the early days of bail-in, people saying they're coming for my deposits, right? So just holding communications that you can pull out that are helpful to deal with disinformation, some very simple things, and how quickly you'll be able to deal with different constituencies. For example, as liabilities are further up and closer to harm's way, when are you going to be able to give them some comfort, if any? How do you deal with foreign operations? How do you communicate to some of those different groups? I think ex ante preparation for the speed of scaling up and the ability to get information out to avoid rumors taking over the narrative strikes me as probably the place that feels like it's got the most benefit in a world where I think you've done a pretty good job of getting out the basics of Title II and some of the basic resources that are available now.
According to Remix News there in Austria, the people, over 5% of the people, I think it was 550,000 out of, was it 8.9 million? I hope I'm getting my numbers correct, but I know it was over 5%, had voted for this referendum to enshrine the use of cash in their constitution. Now, the constitution, the Austrian one, does have a similar phrase that we have in the US Constitution around using coining, government coining and things like that. That was based on an older age. And now that we're in the fiat age and we're moving to the central bank digital currency age, people want to stay with fiat and they don't want to go central bank digital currency, much like they want to stay with gold and didn't want to go to fiat. So the people are rejecting the idea of central bank digital currencies around the world in the nations which use the most cash. And which nation in Europe uses the most cash? Well, that would happen to be Austria, where over 50% of transactions are in cash. Can you imagine 50% of transactions being cash here in the United States? We'd be passing cash back and forth, right and left, but we use more credit cards and electronic. Well, Germany also uses a lot of cash and they're rejecting it as well. Their population is rejecting. So the users of cash in Europe are rejecting. I think the central banks are trying to go after those first to get rid of the squeakiest wheels so that they can implement central bank digital currencies across these broad swaths of regional economies, such as in Europe, the United States, Asia Pac, and elsewhere. And today we're going to talk about de-dollarization. This has been a recurring theme on our channel for quite some time. We were one of the first to cover the IMF plans to remove cash from society, and also the BIS's plans and how they're recapitalizing the banking system, including the use of gold. Well, as we march down this path of de-dollarization, the end of the dollar fiat era, and we move into a new multipolar era of competing currencies, we have another news item out that has Iran and 9 other Asian central banks stopping the use of SWIFT and the dollar and using an alternative system. And we're going to talk about that today and how impactful that's going to be on adoption of the dollar. For those people that think that the dollar will last forever or is invulnerable, I think that's been disproven many, many times. And while it may take time for the world to release its hold on the dollar, for the dollar to release the world's hold on its exclusive hold on use in international trade as a currency, as we continue down that path, we're going to see more and more of this news. And this comes from mainstream media as well as local sources as well. We're going to start off by an article in Forbes. This came out in May. Iran urges Asian partners to drop the dollar from bilateral trade. It says here, members of the Asian Clearing Union, this is the ACU, which has the 9 different Asian members that are going to participate now in Iran system, dropping the SWIFT, which include India, Pakistan, and Iran. They're launching a new cross-border financial messaging system in the coming weeks as an alternative to the main existing international network SWIFT. According to officials from Iran, which currently chairs the body, the members of the bloc agreed at a meeting in the Iranian capital of Tehran on May 24th that they would set up a new system within a month. Now, technology takes time to implement, so obviously the technology was already there. It had either been developed for someone else or something that they had been working on. The announcement comes, obviously, as they're ready to start adopting that technology. A quote from the article, the ACU countries decided to have a customized system for themselves, considering that SWIFT is not available to all countries and given that it has its own costs, says Central Bank of Iran Deputy Governor Mohsen Karimi, and comments reported by the Iranian state-owned Fars news agency. Well, why are these countries doing this? Why are these 9 Asian Clearing Union countries adopting Iran system over SWIFT, which has been the standard basically as long as we've been doing wire transfers in the modern age? And that's basically because the U.S. sanctions on Iran and other countries are preventing some of these countries from using SWIFT, and so they had to develop their own system. Of course, Iran and Russia are developing their own systems as well, as we've talked about. And what we have now is a collection of regional systems popping up to replace SWIFT as a de facto international system, much like these other currencies will replace the dollar as a de facto international currency. It's the same thing. They're just setting up the processing networks. But in these processing networks, they're not using dollars. They're using alternative or other currencies or local currencies. Silicon Valley Bank is shut down by regulators in the biggest bank failure since the global financial crisis. The FDIC said in an announcement that insured depositors will have access to deposits no later than Monday morning. SVB's branch offices will reopen at that time under the control of the regulator. They've been put into receivership. The FDIC standard insurance covers up to $250,000 per deposit per bank for each account ownership category. We'll provide you more on that here in a moment, and as how many of these accounts may be reimbursable under the FDIC's insurance scheme. For those not familiar, in the banking system in the United States, the FDIC, the Federal Deposit Insurance Corporation, is an insurance fund for bank deposits that or banks that may go bad, and for depositors to get their money back. In other words, if the bank doesn't have the money to give you all your money back and from your account, the FDIC will typically step in and guarantee that up to $250,000. Over $250,000, there will be a certificate scheme. In this particular case, which we'll go over in a moment, and I'll talk more about the FDIC's solvency and how much of this they can handle before they run out of money, because remember, it's an insurance fund. It's not one-for-one with deposits in the banking system. It has a much smaller war chest there to cover these. So we'll see if this is the only bank failure, the FDIC may be able to cover this, but it's going to significantly impact their insurance fund. And we'll have to see if any more bank failures come, which further challenge the FDIC's reserves for this type of situation. It says here on CNBC, financial regulators have closed Silicon Valley Bank and taken control of its deposits, the Federal Deposit Insurance Corp announced Friday, and what is the largest U.S. bank failure since the global financial crisis more than a decade ago. The collapse of SVB, a key player in the tech and venture capital community, leaves companies and wealthy individuals largely unsure of what will happen to their money. According to press releases from regulators, the California Department of Financial Protection and Innovation closed SVB and named the FDIC as a receiver. The FDIC has created the Deposit Insurance National Bank of Santa Clara, which now holds the insured deposits from SVB. The FDIC said in an announcement that insured depositors will have access to their deposits no later than Monday morning. According to press release, SVB's official checks will continue to clear. As of the end of December, SVB had roughly $209 billion in total assets and $175.4 billion in total deposits. According to the press release, the FDIC said it was unclear what portion of these deposits were above the insurance limit. I know exactly what that is, at least according to a chart that's been released, and I'll show you that here in a moment. And it's not good, ladies and gentlemen. It is not good. This is not a good situation. This has the potential to maybe spark some other contagion in the market. We don't know yet. And I'll get into why this particular bank, I think, is having issues. And we'll talk about the potential for whether or not this could spread to the rest of the economy.
The financial system globally has been built around extremely low, ultra low interest rates for 10 years. All of these things that got built up over the last decade are going to have to be dismantled or changed.
We will keep at it until we're confident the job is done. Thank you.
We lived in a bubble, in a dream, and this dream and a bubble is bursting.
Rising interest rates in the U.S. and many other countries are intensifying fears of a recession.
Ever since that Fed meeting at Jackson Hole, we've been getting mixed signals about the economy. Is it bound for recession, or is it in a booming recovery?
An economy with such a strong labor market is not in a recession.
At the center of the debate are the actions of the Federal Reserve, which seems to have our economic fate in its hands.
The Fed is trying to stop inflation, but is the medicine worse than...
President's going to leave the station without you.
Okay, with Wall Street shaken to its very foundation today.
We're in the midst of a serious financial crisis, and the federal government is responding with decisive action.
The Bush administration...
The president and Congress spent hundreds of billions of dollars to restart the economy, but at the center of the rescue effort was the Federal Reserve. Richard Fisher was the head of the Fed's bank in Dallas at the time.
What the Federal Reserve does is provide the blood supply for the body of our capitalist economy. And what happened in 2008 is all the veins in the capillaries and the arteries collapsed. So every financial function had failed. It had collapsed, and we had to restore them.
Yeah, and this is you just mentioned the very firm who hasn't lost a penny in any trades in all the years, and basically that we know of, and they certainly boast about it, but that also got labeled as a criminal enterprise by the Department of Justice, and so yeah, I mean, you know, this it's in your face, and I think it's so blatant. And I remember when I worked for many years with dear Bart Jilton, who is passed on now, and he was a real star of a CFTC. Well, I mean, the commissioners are quasi judges, so obviously anything that gets done has to pass through the grid or the network of, you must have at least three commissioners voting yes, even if two vote no, so it can go through, and it would always be a problem. And it was like, yes, we all know it's going on, but you know, then you kind of wonder, but how much vested interest is, because he talked about, you know, when we're trying to, he said, we're trying to do these investigations, and you've given us 88 examples of exactly where the price was going to be the next day. And yes, obviously this is credible, and we know it's happening. But the thing is how do you pin these guys down? And it's like, so, I mean, literally, how you pin these guys down? Because yes, you can provide evidence, and yes, the policeman that you spoke to, he's a policeman, he is integral. He is very likely wants to do his job like any good policeman. But the thing is then in the meantime, the commissioners are deliberately tied up. And so you've got massive lobbying going on. And he said, do you realize that every single day, almost without exception, we have fleets of JP Morgan lawyers in here tying us up, literally tying us up. There's no bandwidth left to do anything. It's like, and it's deliberate. And this was at the very same time when I think the head of the CME and the head and one of the lawyers from JP Morgan, I'll never forget it, was trying to defund the CFTC. You've got way too many people. Guess what? At JP Morgan, we got 300 lawyers here. We could do a better job. Unbelievable stuff, Rob.
Two major stories to report to you next week, one domestically and one abroad. We'll start with the domestic one. According to the Department of Justice, printed on August 22nd, press release, former JP Morgan precious metals traders sentenced to prison. The subheadline is, defendants were JP Morgan's former head of global precious metals business and JP Morgan's former head gold trader in New York. Reading from the article, two former precious metals traders at JP Morgan and Chase Co., also known as JP Morgan, were sentenced today for engaging in fraud, attempted price manipulation, and spoofing as part of a market manipulation scheme that spawned over 8 years, involved tens of thousands of unlawful trading sequences, and resulted in over $10 million in losses to market participants. Greg Smith, 59, of Scarsdale, New York, was sentenced to 2 years in prison and a $50,000 fine. Michael Nowak, 49, of Montclair, New Jersey, was sentenced to 1 year and 1 day in prison and a $35,000 fine. A quote, the defendants used their positions as some of the most powerful traders in the worldwide precious metals market to engage in an egregious effort to manipulate prices for their benefit, said Acting Assistant Attorney General Nicole M. Argentieri of the Justice Department Criminal Division. The case reaffirms the department's steadfast commitment to hold accountable those who engage in fraud and manipulation that undermines the investing public's trust in the integrity of our commodities markets. Further quote, as today's sentencing demonstrates, the FBI and its partners remain committed to investigating and bringing to justice anyone who attempts to manipulate our financial markets for their own selfish gain, said Assistant Director Louis Quesada of the FBI's Criminal Investigative Division. Goes on to say, in order to maintain economic security, investors in equity and commodities markets must have confidence that exchanges are operated in a transparent and equitable manner and that investments are free from manipulation and fraud. Today's outcome should serve as a reminder that the FBI remains highly focused on combating bad actors conducting sophisticated fraud schemes targeting the securities and commodities markets. A further note in the DOJ article, in September 2020, JP Morgan admitted to committing wire fraud in connection with 1, unlawful trading in the markets for precious metals futures contracts, and 2, unlawful trading in the markets for U.S. Treasury futures contracts, and in the secondary or cash market for U.S. Treasury notes and bonds. JP Morgan entered into a 3-year deferred prosecution agreement through which it paid more than $920 million in criminal monetary penalty, criminal disgorgement, and victim compensation, with parallel resolutions by the Commodity Futures Trading Commission, CFTC, and the Securities Exchange Commission, SEC, announced on the same day. The FBI New York field office investigated the case. The CFTC's Division of Enforcement provided valuable assistance. That is our domestic story, and goes to point out that there is a lot of manipulation going on in the precious metals markets. 10 to 20 years ago, people would have thought you're nuts. My first article that I ever wrote on any blog, which was on Seeking Alpha, or actually the first couple of articles, was about manipulation. This is about 12 to 13 years ago. I was told I was a fraud, a phony, and was crazy. But now it's nice to see 10 years, 15 years later, that a lot of these people that are manipulating those markets are being brought to justice. Hey everybody, this is Rob Keens with goldsilverpros.com, recording on September 7th, 2023. Today's presentation is real estate. This is one I've been wanting to do for a while. A lot of you may not know this, but before I got into gold and silver around 2009, I had been running real estate investment firms on my own here in North Texas. We started in 2000, and I ran 2 LLCs in North Texas, renting, buying, and selling homes for almost 20 years. We did pretty well at that. I did that on the side while I also worked a full-time job and got a master's. And then it wasn't until 2018 when I sold my homes and moved a lot of my wealth over into the precious metals and paid off a lot of debt and basically restructured my entire investment portfolio. So I have been following real estate and looking at real estate statistics for over 25 years because I researched this a couple of years before I actually started buying them in 2000. I have a lot more experience actually in real estate than I do any other single financial market. And so I've been connected to what's going on in the market. And what I have been seeing, and I predicted in 2018, when I liquidated the last of my rental homes, was in a few years where we're going to start to have a rental crash, or not a rental crash, but a housing crash, which would incorporate both the rental and the sale markets. And now I'm going to bring to you a whole bunch of data, a data series I've been working on for a very long time, as to what's going to happen and why real estate will be next. The title of the presentation is "The Data Don't Lie, Why a Housing Crash is Next." And away we go without further ado. Home for sale. Is this the path to riches? Yes or no? Well, let's take a look first at overall real estate prices. And I've graphed this back to the 1980s. So this is before I even got involved in 2000. This predates my personal experience as an investor by about 15 years. And from about 1985 to about 2005, 2006, we had a 291% increase in home prices. Sounds pretty good, right? That means people did pretty well. Well, it was only, annualized a 1.65% average yearly gain, because the rule of interest rates is you take the gain you have one year, you capitalize it back into the price, and then you multiply the gain the next year. So it's basically an exponent problem of figuring out how much it increased per year. So only 1.65% per year. Not a huge bubble in real estate over that period of time. Of course, we know what happened in 2007 and 8. We had a crash, and it alleviated about 27.5% of home price values. Now, they didn't come back down to where they were in 1985, but they did come down to where they were right after the tech crash in the early 2000s. So we lost about 4 to 5 years of real estate value in that crash, which lasted from 2006 to about 2012. So before the Lehman crisis, there had been 2 years of declining real estate prices, which led to the mortgage-backed security crisis. And we'll get into mortgage-backed securities here in a moment, and we'll see the absolute ridiculous explosion in them in just a few moments, and why this bubble is so much bigger than the bubble that crashed in 2007, 2008. And what that's going to mean, ladies and gentlemen, is this housing crash is going to be worse. Now, you look at the acceleration for the last 10 years of real estate prices. I just graphed 2012 to 2022, and we had a 223% increase, and the average annualized rate was 8.5%. That is right, 7% more per year, or another way to look at it, homes rose over the last 10 years, 4.5, almost 5 times as fast as they did the previous 45 years. That's right. Home prices rose 4.5 times faster in the last decade than they had in the previous 4.5 decades overall, meaning just by that number alone, you would think we're in a bubble. Of course, we know that the Fed has printed more money in that period of time. So a lot of money got pushed into the stock market and homes and things like that, because when you print more money, it's got to bid prices up somewhere in the economy. It's bid up energy. We've had high inflation. but it also bid up housing costs. And we're going to see the consequences of that as we go along. But I want to emphasize here a modest 1.65% average annualized gain over 4 decades. And we had a 27.5% housing crash over a period of 6 years, which led to the Lehman collapse and almost a collapse of the global financial system and the Great Recession, if the pundits were correct, if we listened to what everybody said back then since the Great Recession. Well, fast forward 14, 15 years later, and we've had 4.5 times the growth rate. What's the crash going to look like this time? But it says here, and this is according to reporting by Bloomberg, the logistics are daunting. Many borrowers were assigned a new loan servicer after some of the biggest companies, such as Navient Corp, quit the federal program. They're not in the federal program? The Biden administration's failed attempt to forgive some of the debt has left some folks confused about whether they need to pay at all. Then there's bewilderment over income-driven repayment plans and the legions of scammers sure to be looking for easy marks amid the upheaval. It could be a mess. In fact, the 6 senators that wrote the letter to the servicer said this is a big concern. Scammers, who to pay, where to pay, how is this all going to work? You see, when you make a top-down decision to try to forgive student loan or change the system, and you have all these companies below it, they may not all get the memo or be equipped to deal with this rapid back and forth change, which is exactly what happened when the Supreme Court rejected the original plan to forgive student loan debt. Now, the current administration is trying to use executive administrative powers to change some of the repayment terms, and that's what this slide is talking about. It's confusing as hell. And really, no one knows what they're supposed to do. Not the borrowers, not the government, and certainly not the servicers. So, you know, maybe not a big deal. Maybe it is an IT problem. Maybe we'll figure out in a few months, everything will be okay, right? Just a teeny little problem. Don't worry so much about it, except, well, there was a study done by Morgan Stanley Research, and they're pointing out here households less prepared to make payment. You see, ladies and gentlemen, when people were told that they weren't going to have to repay their student loans, they might have spent that money elsewhere or breathed a big sigh of relief because they didn't have the money to pay them off anyway. And it's here, according to the slide, overall, over a third, 34% of people will not be able to make their monthly student loan payments. That's the purple part of the bar you see over on the left. And if you break it up by income strata, the second from the left bar has 47% of people making under 50,000 will not be able to make all of their monthly payments. Another 31% say that I will have enough money to make payments, but I'm going to have to stop spending elsewhere. Well, what does that imply? That money has to be pulled out from somewhere else in the economy. So when this $1.5 trillion student loan debt finally hits and they figure the whole thing out, 31% of people under 50,000 say they're going to stop paying for other things. 41% of people 50 to 99,000 say they're going to stop paying for other things. Overall in the economy, 37% say they'll stop paying for other things, and 34% can't pay for any of it. Of course, as you go up the income strata, more people can substitute or make those payments. But overall, the numbers don't look good. Well, wait a minute. So not only could we have issues with servicing that $1.5 trillion in student loans, which is a gigantor piece of this economy. Yes. Arum it's listed as an infrastructure project, but really more than that, it's tying all of the central bank digital currency to gold. Now, let me just go explain. So here is a quote from Project Arum page on the BIS website. Arum, quote, Arum is a retail CBDC technology prototype comprised of a wholesale interbank system and a retail e-wallet system. Remember, you have wholesale central bank digital currencies and retail. Wholesale is for central bank settlement. Retail is for everybody else. Okay, they have to have those two tiers to control that system. This sets up 2 different types of tokens, according to the website. Intermediated CBDC, that's what we talked about last time, where there's no stable coin. It's just different central bank digital currencies trading with each other. That's intermediated. It means you have all these parties in the middle making sure everything's working, and technology. That's all that means. And then stable coins. Oh, that's a new concept, stable coins. What's a stable coin in the private crypto world? It's a coin backed by something, typically US dollars or some other, stuff. It could be gold, but most often it's something else. Well, in this case, it's actually going to be gold. I'm going to show you. So they're going to do a stable coin backed on gold. And it's what they're saying, backed by CBDC in the interbank system, but ultimately backed by gold because the central banks are holding gold as one of those assets. Other things as well, other currencies. So while intermediate CBDC is a direct liability of the central bank, the intermediate CBDC means just the central bank digital currency itself. The central bank is liable for that because they issue it. While regular wholesale CBDCs, are liabilities of the central bank, the CBDC-backed stablecoins are liabilities of the issuing banks, so the commercial banks, with backing assets held by the central bank. So in other words, think about the Fed system where banks are depositing money to the Fed, and the Fed, is using those assets. Think of the repo market. Think of those types of things where you put an asset in there and you get credit with the Fed, however all that plumbing works. That's what a stablecoin is. The backing assets are held by the central bank. So the banks put something into the central bank digital currency or the central bank system, and they get central bank digital currency issued to them. So it's like a collateral-based system. And the prototype is designed under the principles of safety, flexibility, and privacy. So in other words, they ultimately realized they needed something to back the system up. If they just went straight digital currency right out of the gate, they wouldn't see adoption, they wouldn't see support, the system could collapse. So they're putting a certain amount of gold into this system and other things like other currencies to stabilize it, and that's where the stable coins come in. That's all you need to know. The stable coins is an anchor to things that they perceive of real value, all defined in Basel III. Remember when I did the Basel III series and I said gold's in there, stock of other banks is in there, and currencies is in there. Well, guess what the stable coins are going to be built on? The things that are in Basel III. That's how it's connected. So Basel III is a precursor or a prerequisite or something that had to be set up before they got to central bank digital currencies. So when we talk about when Basel III was first conceptualized in 2012 and put into practice in 2014, and then the IMF paper came out in 2015 around electronic money, and then the development of the concept of central bank digital currencies, all this stuff's been put into place for over 10 years publicly, and probably talked about for about 20 behind closed doors. And that's how all of these things I've been talking about on the program are all connected. We're starting to see the end result of all of those things, all of those maneuvers in the system, all of those projects, all of those standards, all the things I talk about that a lot of people don't want to listen to, except for on my channel, you guys do, but that are so important. And that's why all the stuff that I've covered today is so important, understanding the system now. It is so important. So you guys have been with me for years who have followed this. We're getting to the end game. We're getting to what you really wanted to know. All that stuff leading up to now was building. All right. Continued. Here are the core principles of Project Arum. Safety. The wholesale interbank system can detect and prevent banks from, one, over issuance of retail CBDCs and wholesale CBDCs, double issuance using the same CBDC asset to issue retail repeatedly, or double redemption using the same retail CBDCs to exchange for wholesale. So wholesale is the base currency, retail is the offshoot. So they don't want you taking that same like dollar bill, digital dollar bill, and getting multiple credits for wholesale CBDC. They don't want people issuing multiple retail units off a single wholesale CBDC, and they don't want more retail CBDC than the whole than what's backed by the wholesale CBDC. So this is integrity and safety of that currency system, so that unlike a dollar or a gold-backed dollar standard, they don't overprint the dollars, if you will. And essentially, they're building it like we don't want to overprint, which in digital currency it doesn't really matter. They can just issue more, but they want the transactions to match one for one to have integrity. Why? Because they want the system to last. It's not good for us that that system has this integrity. That's why they put it in there. So users can still prove ownership of the retail CBDC. So what it does do, if you're a retail holder of these digital dollars or digital yuan or whatever, it's going to guarantee that that's your money. Now, that money may not be worth what you think it is. That's the real risk. But they're going to make sure that there's not counterfeit in the system. And the system achieves increased cyber resilience through decoupling between the wholesale, interbank, and the retail e-wallet system. There's a separation to where cyber attackers couldn't get in and muck up the whole system. They're compartmentalizing. And being a former cyber guy, that actually is a good attribute of any monetary or other financial system. So flexibility, the ARM system can be adopted under different CBDC models. Intermediate CBDC, that's just CBDC to CBDC trade, or stablecoin, in which CBDC is backed with something, okay, to give it integrity. Because people aren't just going to trust central digital currencies out of the gate. No one is. And that's where the stable coins come in. And that's where the backing by gold and other assets comes in. It controls the amount of information disclosed by the e-wallet system. So by separating those two and by having integrity on the two separate chains, digital ledger technology chains, you can ensure that there is some privacy at the individual level, although the authorities can still see what you're doing. But the other, like I could send money to and from the system and my neighbor wouldn't know, essentially is what that means. It's protecting the people from the people, not the people from the owners of the system, if that makes sense. Privacy, retail transactions are not disclosed the whole interbank system, but they can be looked at a centralized level. There's a project for that. It's on the BIS's webpage. I didn't put that project on the second slide, but it's there. Go look at the BIS's webpage. And then users, cryptographic secrecy, if you will. In other words, making sure the system has integrity by making sure the individual transactions can't be hacked or seen or the encryption broken, if you will. And again, this sounds good if you're a retail user. What it really means is the people running the system can see everything, just your neighbor can't, if you will. That makes sense. So here's the diagram and the tech stack. Not super important except for my IT people. I'm going to throw it up there for a second, but I'm going to talk about other stuff. So if you want to look at the flow diagram, great, it's there. I just put it there to note the system exists. It has resiliency. One bank can go down, the others, that's the cool thing about digital ledger technology and the blockchain, if you will, is that one node can go down and the others can be up and you've got resiliency. So it's not like, in the old days where a bank goes down, whether it closes or power goes out or the ATM stopped working and you're screwed. In this system, actually, each node has a copy of what's going on. And so if one node goes down, it's actually more resilient from cyber attack, power outage, temporary closure of something, server maintenance, whatever the case may be, or individual banking issues, if that makes sense. The system does make sure that you have access to your money, but it also means you have no privacy and no way to get out of that system. Aha. All right, moving on. The last project we're going to talk about today, and the one that's really going to tie this all together, and this is not on the BIS website. This was a find by one of my subscribers, unitfoundation.org. And listen to two quotes from the webpage. The unit fractal monetary system, ecosystem. Okay. Remember when I talked about fractals a couple of weeks ago, one of my subscribers said, talk about fractals. And we use fractals to show where the gold and silver price could go in a fractal system. And fractals are not linear. They're more akin to exponential, meaning, the example I use is in nature, you could have a spiral mathematical pattern in a small mollusk. You could have it in a bigger hurricane, and you could have it in a galaxy or the universe. So there are mathematical concepts that can exist at the microscopic level, at the atomic level, that scale all the way up to the universal level. And this is, in fact, fractal is a mathematical representation of how the universe actually works, from the micro level to the macro, small to big. Well, guess what? They're putting that in the monetary system because they realize to have control, you don't want hyperinflations and blowups. And so the Unit Foundation is building a system that is not impervious, but very resilient to hyperinflations. And I'm going to kind of explain how that works. But using the concept of fractals, the system can grow no matter how big it needs to grow. Why? It's electronic. Yeah, there's maybe some gold backing, stablecoin backing, but ultimately Unit Foundation is to get off of stablecoins, get off of commodities, get off of gold and silver, and put us into a one world currency that can expand or contract whenever they need it to without breaking the system. Does that make sense? So that they have full control at all times. You don't have hyperinflations or big crashes in the system. It can scale up or down, but it has no tie to nature, natural money, that type of thing. And who's going to pay for all that? Well, it's going to be the individual, of course, through devaluation of money, devaluation of whatever the case may be. Okay, but remember the discussion I had on fractals weeks ago about how the value of gold can go up or down, or any value can relatively go up and down in a system depending on what the system needs. That's what fractals explains, where they're using that in money. And this is an extremely powerful concept that could lead to electronic money that can never hyperinflate, never be extinguished, and by its nature, never allow you out of that system. All right, going back to the quote. The unit fractal monetary ecosystem introduces a practical approach to creating essentially apolitical money. Worldwide currency. Apolitical money, what does that mean? We don't care if you're in China or the US. It works everywhere. What is that? It's worldwide currency. That's all it is. Okay, back to the quote. That can be freely used as a storage of value or currency for payments via any open payment and clearing system. So what are they doing right now with some of those projects? Project Fuse, Project Polaris. One, they're making the system agnostic to the current banking system by building a connection layer. And two, they're going to bring everybody up to the same standard with Project Fuse. That's the step one, is what they're doing now. Unitfoundation.org is saying, let's use a fractal system to even build around that and say, we don't even care where you are, we want global money, and it can go across any system, while providing long-term purchasing power stability. The unit ecosystem is proposed as a solution to the basic lack of trust problem stemming from the politicization of the use of a single global currency and constraints on its use for valuation and settlement of trade and capital flows. In other words, we don't want another dollar-based system, because if we have another dominant single currency system, the rest of the world will never agree. China and Russia will never agree to this. Japan will never agree. Zimbabwe will never agree. But if we can get it to where there's one global currency, you can have your individual retail currencies, but we want one global currency to unite them all, one ring to unite them all, one global currency to unite the world. You do it using a fractal ecosystem, agnostic of individual political boundaries and individual currencies, that holds its value and doesn't allow any one political military regime to control the rest of the world, or economic system to control the rest of the world. So on its face, it looks, oh, that's wonderful. It gets rid of any single currency system that had been the problem plaguing civilization the past, thousands of years. And it would just equalize everybody. Yes, but if you equalize everybody, you take away everybody's what? Sovereignty, privacy, and control. That's ultimately what this is. All right, second paragraph. We introduced a fractal monetary framework which allows global financial system to function without directly using any national currencies for international trade and reserves. This is the end game. This is after the step I just told you. Arum and all those other projects are to get everybody on board with central bank digital currencies, and we'll figure out the back end later. And they'll get there on the technology side. Unit Foundation is essentially to make it to where none of that even matters, and we go to a true global centralized digital currency. The unit is designed to serve as a convenient and stable global currency alternative within the existing infrastructure. It's expected to be more resilient than any national currency to political exigencies of the day. So you guys can go to war as much as you want, but you're not going to break the global financial system. You guys can issue as much universal healthcare as you want without breaking the system. You guys can F up your debt markets without screwing the system. This system will be in place forever and ever and ever. It's designed to be an ever and ever system. And within that system, we'll absorb the current. How do they do that? Well, 40% of this is backed by gold. Let's go to how it works. 40% gold. That's where the stable coins come in. Project Arum comes in. If you understand Project Arum is to allow the unit framework to work. You're putting 40% gold in the system, 60% other currencies. No one currency could dominate more than 30%, I believe, of transactions, if I remember correctly. And they can move that up and down because it's a blockchain-based thing. You can change the rules as you need, but essentially it keeps the system, any one political regime from breaking the system. So it takes away the excuse of any president or prime minister or cabinet or Congress not to adopt the system. They're making it to where no one can say no.